Okay, so 6.2 is the allowance method of recording uncollectible accounts expense. We have three objectives. You need to be able to calculate and record estimated uncollectible accounts expense using the allowance method. You need to be able to write off an uncollectible account receivable, and you need to be able to account for the collection of an account that was receivable that was written off. This allowance method is what we used in accounting one, so hopefully this should be kind of review for us. First, they talk about that accounting concept matching expenses with revenue. So uncollectible accounts expense should be recorded the same fiscal period in which the sales revenue is received. Because a business has no way to know for sure which customer is not going to pay an amount due, the application of matching method requires an estimate of uncollectible accounts based on past history. So they're going to look at some past history. It might be percentage of sales that are uncollectible, that type of thing, to figure out what they believe will be uncollectible. Crediting the estimated value of uncollectible accounts to a contra account is called the allowance method of recording losses from uncollectible accounts. So estimating uncollectible accounts expense. So here's what I was talking about for how we figure out that amount. Two methods are commonly used to estimate uncollectible accounts expense. We have our percentage of sales method, and then we have our percentage of accounts receivable method. The percentage of sales method is going to assume that a percentage of each sales dollar will become an uncollectible account. So no matter what our sales is, a percentage of our sales will be uncollectible. The percentage of accounts receivable method is going to assume that a percentage of accounts receivable at the fiscal year end will become uncollectible. So this one is looking at our sales. This one is just looking at accounts receivable, who owes us money. Regardless of the method that we use, the estimated amount is charged to uncollectible accounts expense. And the difference between an assets account balance and this related contra account allowance balance is called our book value. Okay, so first we have to do our adjustment. So this one is showing us our adjustment using our percentage of sales method. We're going to compute our estimated uncollectible accounts expense by multiplying our net sales by our percentage estimate. So in this example, they're estimating that 0.4% of our sales are going to be uncollectible. So we're going to take our net sales times that percentage, and that gives us our estimated uncollectible accounts expense. To put that then as our adjustment, we're going to record that as a debit to uncollectible accounts expense and a credit to allowance for uncollectible accounts. This was looking at the adjustment using aging of accounts receivable. Analyzing accounts receivable according to when they are due is called aging accounts receivable. So here we're looking at the days that it is past due. And what we're assuming is that accounts that are 1 to 30 days past due, 5% is going to be uncollectible. 31 to 60 days past due, 10%. 61 to 90, 40%. Over 90 days past due, 80%. Notice these percentages are going to rise the longer they are past due. And that's just because if we don't receive it in those first 30 days, the likelihood that we are not going to receive that cash is going to increase over time. So here they're showing us the percentages then. So what they did is here's the current amount that is owed to us, and we're assuming 2% of that is going to be uncollectible. We're going to multiply those two numbers together to get our uncollectible amount. Same thing with the next group, 1 to 30 days. Here's the amount that is due. We're going to assume 5% of that is uncollectible, so here's the amount. So we're going to figure that all out. So our total estimate is right here, $5,206.78. Here they're showing us our current balance of allowance for uncollectible accounts. So in our account right now, we have $308.64. So we want that account to equal or to be able to cover this $5,000 that we think is going to be uncollectible. So that means that we need to add in this amount, $4,898.14, to make it equal what we believe is going to be uncollectible. All we did here to get this number was subtracted these two. All right, so now we're going to go ahead and write off an uncollectible account using our allowance method. So we're going to debit our allowance for uncollectible accounts, and we're going to credit accounts receivable, Vance Corporation. So again, when we look just like we did in 6-1, we're writing off that account, so we're crediting that account to bring it down to 0. We're also crediting an accounts receivable to drop down what we are owed, but this time we're taking that money out of our allowance account. Okay, so right now we have built up in our allowance account $5,206.78. We're taking $495.31 out of there to cover that account that's going to be uncollectible. Now notice our book value does not change before and after we write off an account. The book value is still the same. Okay, now we are going to collect on an account that we previously written off. So just like we did in 6-1, we first need to reverse writing off that account or closing that account. So now we're going to reopen it. So we're going to debit the accounts receivable in that account, and then we're going to credit the allowance for uncollectibles. Then for the second entry, we're going to record that cash that we received. So we're going to go to our cash receipts journal. We're going to debit cash, and we're going to credit accounts receivable, and specifically the account that we received the money from. Okay, question number 1. What are the 2 methods that are commonly used to estimate uncollectible accounts expense? The 2 methods are 1, percentage of sales method, and then 2, percentage of accounts receivable method. Number 2, what is the formula for estimating uncollectible accounts expense based on net sales? Net sales times the percentage expected to be uncollectible is going to equal the estimated uncollectible accounts expense. Number 3, how is the addition to allowance for uncollectible accounts calculated using the percentage of accounts receivable method? Okay, compute an estimate for each age group of multiplying the amount of each group by the percentage estimate. Then we're going to compute the total of the uncollectible estimates for all age groups. And then we subtract the current credit balance, or we need to add the current debit balance, depending on what we have in the allowance for uncollectibles, to determine the addition that we would need to make to that account. And question number 4, when can the direct write-off method be used? The direct write-off method can be used when the difference between the accounts receivable reported on the balance sheet using the 2 methods is immaterial. Okay, go ahead and go on to the 6-2 work together.